balance of payments, BOP, is a comprehensive record of a country's economic transactions with the rest of the world over a specific period. These transactions encompass the trade of goods and services, cross-border investments, and transfer payments like foreign aid and remittances. The BOP is systematically divided into three main accounts. 1. Current account. 2. Capital account. 3. Financial account. In the external sector, the current account refers to the account maintained by every government of the world in which every kind of current transactions is shown. Basically, this account is maintained by the central banking body of the economy on behalf of the government. Current transactions of an economy in foreign currency all over the world are export, import, interest payments, private remittances, and transfers. All transactions are shown as either inflow or outflow, credit or debit. At the end of the year, the current account might be positive or negative. The positive one is known as a surplus current account, and the negative one is known as a deficit current account. India had surplus current accounts for 3 consecutive years, 2000 to 2003, for the first time in Indian economic history. As per the RBI, India's current account deficit, CA, stood at 1.0% of the GDP by December 2023, and the country was able to sustain a CAD in the range of 2.00 to 2.50% in 2023-24. Every government in the world maintains a capital account, which shows the capital kind of transactions of the economy with outside economies. Every transaction in foreign currency, inflow or outflow, considered as capital is shown in this account. External lending and borrowing, concessional as well as commercial, foreign currency deposits of banks, external bonds issued by the Government of India, foreign direct investment, FDI, foreign portfolio investment, FPI. In case of the FPI, rupee is fully convertible, while 3-point financial account. This account details investments in financial assets, including direct investment, portfolio investment, and other investments. It reflects changes in ownership of international assets and liabilities. The outcome of the total transactions of an economy with the outside world in 1 year is known as the BOP of the economy. Basically, it is the net outcome of the current and capital accounts of an economy. It might be favorable or unfavorable for the economy. However, negativity of the BOP does not mean it is unfavorable. A negative BOP is unfavorable for an economy if only the economy lacks the means to fill the gap of negativity. The BOP of an economy is calculated on the principles of accountancy, double-entry bookkeeping, and looks like the balance sheet of a company, every entry shown either as credit or debit outflow. If there is a positive outcome at the end of the year, the money is automatically transferred to the foreign exchange reserves of the economy. And if there is any negative outcome, the same foreign exchange is drawn from the country's forex reserves. If the forex reserves are not capable of fulfilling the negativity created by the BOP, it is known as a BOP crisis, and the economy tries different means to solve the crisis, in which going for forex help from the IMF is the last resort. An economy might allow its currency full or partial convertibility in the current and the capital accounts. If the domestic currency is allowed to convert into the foreign currency for all current account purposes, it is a case of full current account convertibility. Similarly, in cases of capital outflow, if the domestic currency is allowed to convert into the foreign currency, it is a case of full capital account convertibility, CA. If the situation is of partial convertibility, then the portion allowed by the government can be converted into foreign currency for current and capital purposes. It should always be kept in mind that the issue of currency convertibility is concerned with foreign currency outflow only. Convertibility in India. India's foreign exchange earning capacity was always poor, and hence it had all possible provisions to check the foreign exchange outflow, be it for current purposes or capital purposes. Remember the draconian FARA. But the process of economic reforms has changed the situation to unidentifiable levels. Current account is today fully convertible, operationalized on the 19th of August 1994. It means that the full amount of the foreign exchange required by someone for current purposes will be made available to him at official exchange rate, and there could be an unprohibited outflow of foreign exchange. Earlier, it was partially convertible. India was obliged to do so as per Article 8 of the IMF, which prohibits any exchange restrictions on current international transactions. Keep in mind that India was under preconditions of the IMF since 1991. After the recommendations of the SS Tarapur Committee, 1997, on CAC, India has been moving in the direction of allowing full convertibility in this account, but with required precautions. India is still a country of partial convertibility, 40-60, in the capital account, but inside this overall policy, enough reforms have been made, and to certain levels of foreign exchange requirements, it is an economy allowing full CAC. 1. Indian corporates are allowed full convertibility in the automatic route up to $500 million overseas ventures. Investment by lidded companies in foreign countries allowed, per annum. 2. Indian corporates are allowed to prepay their ECBS via automatic route if the loan is above $500 million per annum. 3. Individuals are allowed to invest in foreign assets, shares, etc., up to the level of $250,000 per annum. 4. Unlimited amount of gold is allowed to be imported. This is equal to allowing full convertibility in capital account via current account route, but not feasible for everybody, which is not allowed now. Meanwhile, RBI has been following the recommendations of the two committees, the Tarapur committees of 1997 and 2006, set up on it, which had outlined certain fiscal preconditions, signposts, before making rupee fully convertible in the capital account.